2 weeks ago, I posted this video saying that I'm not buying Tesla yet and I gave the stock a hold rating. Since then, 3 investment banks came to the exact same conclusion as if downgraded the stock from a buy to a hold. Let's see what made these analysts change their minds, what's the one metric that all of them mentioned as the reason for the downgrade, and later in the video I'll show at what price I'm starting to buy Tesla stock. The first thing that I need to highlight is that all downgrades came with a price increase. So, in spite of the downgrades, Barclays raised its price target to $260 from $220, Morgan Stanley raised its price to $250 from $200, while Goldman really stood out with a massive 34% increase, setting its price target to $248. So, it's obvious that these banks still like Tesla. Actually, Barclays analysts just reiterated what many investors believe. We see Tesla as a long-term winner in the industry's transition to an electric vehicles world. We acknowledge that there is more to Tesla than just the automotive story. But in spite of this strong belief, what is it that these analysts see that makes them fearful? Firstly, Tesla's recent fast and aggressive move surprised even the most bullish investors, and to quote Morgan Stanley's analyst, while the team has defended the Tesla overweight rating all year, I did not see this 111% year-to-date rally coming. This gigantic move of more than 60% in the last 2 months alone is indeed impressive. And Goldman's analyst believes that the recent price action is because we think the market is now giving the stock more credit for its long-term opportunities. So, let's see what are these long-term factors that the market now sees in a positive light. Firstly, solid monthly sales in April and May. Tesla is expected to deliver a record quarter with an estimate of 440,000 according to FactSet, growing an impressive 75% based on weaker than usual second quarter for 2022. Secondly, Tesla made less price cuts in April and May than the analysts were expecting. For instance, in the US, Tesla cut its prices 6% in April, while in May Tesla didn't make a single price cut. Another reason for the strong uptrend is Tesla's recent partnerships with several competitors regarding its charging infrastructure. I believe this is truly the most important reason, as it proves a strong point. The EVs industry will grow fast and Tesla will be at the center of this transition. As a result of the partnership, the EV's penetration might grow and Tesla's brand might become even stronger, which in turn would mean Tesla selling more cars. Lastly, other reasons for the recent uptrend are the Model 3 IRA credit and the market becoming more focused on Tesla's AI capabilities. Remember that Tesla has a substantial advantage in the AI and has high hopes for delivering a truly autonomous software in the future. Not to mention the launch of the Cybertruck, for which pre-orders have set a crazy record of 1.7 million cars. And while these are all great catalysts that fuel the momentum of the stock, what analysts are focusing on is the short-term risk. We are cognizant of the difficult pricing environment for new vehicles that we think will continue to weigh on Tesla's automotive non-GAAP gross margin this year. Moreover, another analyst from Piper Sandler gave exactly the same advice for what to focus on. You see, while deliveries are important, the analyst argues that the outlook for the gross margin will probably be even more important than production. And I completely agree with his stance. Last quarter, we saw the automotive gross margin decrease to 18% in spite of management promising 20%. The automotive gross margin will be the most important metric, and if it will come around 20%, we might have seen a bottom for the gross margin, which would be great news for the stock. But what options does management have for increasing the gross margin in a period of price cuts? Well, there are two main things. Firstly, Tesla is continually doing improvements in terms of manufacturing and design. Secondly, Tesla can pass some of the cost savings onto their manufacturers. There are 3 important raw materials for an EV: lithium, copper and cobalt, and since these raw materials got cheaper in 2023, Tesla might find a way to improve its gross margin. As a result of the volatile gross margin, the analysts from Piper Sandler warned investors that we might see some selling as a result of profit taking, no matter how good deliveries will look this weekend. Moreover, analysts now anticipate that lower pricing for new cars, in conjunction with softening auto demand because of the macroeconomic environment, will be additional headwinds for Tesla. This is something that Elon Musk warned us just a month ago.
This is going to be a challenging 12 months. Tesla is not immune to the global economic environment. I expect things to be, just at a macroeconomic level, difficult for at least the next 12 months. Tesla will get through it and we'll do well, and I think we'll see a lot of companies actually go bankrupt.
So, are more price cuts coming? While nobody knows for sure, we can estimate looking at the demand. And the best metric is the backlog, which is the number of buyers waiting for their car to be delivered. At the end of May, Tesla's backlog was around 70,000 cars, growing from 68,000 but still below 100,000 cars. If the demand doesn't increase as Tesla grows its production fast, we could see the backlog dropping, which would lead to more price cuts. Next, to bring it all together, all three banks put this next metric as the reason for the downgrades. You see, as I highlighted before, Tesla stock became more than 3 times more expensive on a PE basis compared to the beginning of the year. Moreover, this is just from multiple expansion, as nothing has changed fundamentally for Tesla's estimates. Actually, the revenue estimates for the next 3 years have been revised downwards, with revenue for 2023 expected to be 11% lower than at the beginning of the year. The same goes for earnings, which have been revised lower by a huge 36% year to date. Additionally, if we compare Tesla to some of the AI-fueled stocks like Nvidia or AMD, Tesla became now significantly more expensive than these software stocks. So, the most important argument for the downgrades is that valuation just caught up with Tesla stock. The stock grew very fast because of its incredible long-term growth story, and it kind of ignores the difficult macroeconomic environment, which will bring lower consumer demand and volatile margins for car companies. So, when is it feasible to buy Tesla? I believe that $150 is a good price target to add Tesla stock. It has been a recent support, and if nothing extreme happens to the fundamentals, I believe it's a good entry point. Moreover, the $208 price might be another level where you can open a small position in case you don't want to get fear of missing out. But please be careful and don't go all in. If the stock will be volatile, more buying opportunities will arise for sure. To sum up, the analysts are now reiterating exactly what I said before. Long term, they're still bullish on Tesla as they see it as a long-term winner in the race to an EV world, and even calling Tesla a must-own in the auto space as the industry evolves into one of the greatest industrial changes in over a century. But for now, we need to consider the short-term risks as the following months might prove difficult for Tesla. And I'd like to leave you with an important piece of advice for the future.
If there's a dip, buy the dip.
Alright, that's it from me. If you want to see more financial analysis on Tesla, please hit the like button and subscribe.